I'm going to break down the key ingredient smart money uses to manipulate markets. And using this tactic, I was able to make $12,000 last week. I have a video going over all the broker statements showing all the proof down below. But not just that, this tactic played a huge role in my journey from trading in my high school library 6 years ago to being now a full-time trader for the last 2 years, traveling the world and mentoring over 300 students to this day. And the only reason I'm making this video is because I made a thread on it on X and it blew up overnight. And literally after just 2 days of posting this, I already had you guys in the comments tweeting that it was making you money already. So in this video, I'm going to dive in the charts and go more in depth on the 50% rule so you can walk away with a clear plan on what the 50% rule is, how institutions use it, how it's used to spot bear and bull traps with live examples, and finally, how you can immediately apply this rule to your trading to make more money. Okay, so quick disclaimer before I get started, I just want to let you know that this is time frame independent, meaning I'm going to show you a few examples on a daily or weekly time frame. I'm going to show you some on like a 1 minute or a 5 minute. This works on all different time frames, okay? So don't worry about the time frame I'm looking at. It's going to work for scalping, going to work for swing trading, any time frame at all, it's going to work. But let's go ahead and dive in and start with what actually is the 50% rule. Now, the 50% rule only works when you think of the markets like an actual product. So what I need you to do is take your frame of trading and stocks in general and throw it out the window for just a second, okay? And I want you to imagine this chart right here is the price of coconuts. Okay, we're gonna look at the price of coconuts. And so you can see, obviously, the price of coconuts was at $4 back in November, and it went all the way to a high of about $13 for, we'll say, the price of one coconut, okay? So obviously, that's a pretty big jump. As an institutional buyer or seller, what kind of information can we make from this? Well, we can say that it's pretty obvious that we want to be buying coconuts when it's down at $4 per coconut, right? We want to be buying it all the way up at 13. That's when we want to be selling them, right? So there's going to be less people who are going to be buying all the way up here and more people buying down here. Now, the way that we actually go about this is that we make a range within the product, okay? So if this is coconuts, what we want to do is see, okay, where do we develop a range? That's the first thing. And you can see we develop a very clear range from a low here of about, again, $3.50 or $4, and then a high all the way up about $13.55, okay? And once we have this in play, we have now established a range for our product that we can now have an analysis on. And so now that we have a high of 353, we have a low of 350, we can now establish our range and understand what is considered fair value. And this is where the 50% rule comes into play. So what I'm going to do is I'm going to take my Fibonacci retracement tool. I'm going to go from the low all the way up to the high, and then we can establish the 50% retracement mark right here at about 850. Okay, so I'm going to go ahead and draw that in. Call that our midpoint right there at 850, and then we can go ahead and get rid of this Fibonacci tool like that, okay? So this is what we consider our midpoint, all right? And we're going to just make a dash so it's a little bit easier to see. But this is what is considered fair value. Now, this is a very, very important number or concept to understand because, again, this is what is considered fair. And fair means there's going to be an equal amount of buyers and sellers. So as a buyer of coconuts, I am comfortable buying at $8.50 because that is what is considered fair, right? When we have a range established from a low to a high, we obviously want to be buying at what is a fair market, which would be $8.50. Now, if I am an institutional buyer or I'm someone who likes to buy a lot of coconuts, obviously, I would rather buy lower and get a good deal on it, okay? And so this is where the 50% rule comes into play because anything below the 50% rule or below this 50% mark is going to be considered a good deal or a discount, right? It's like if the price of coconuts are at $8.50 and then you see they're having a sale one weekend, it goes down to $7, you're going to want to buy them then, okay? Because you're getting a much better deal when fair value is considered $8.50. Now, establishing this range, it's pretty obvious that we want to be buying below the 50% retracement mark. But that's not at all what this rule is actually about. Because if it was, it'd be way too easy. You would just wait for retracement, have it go below 50%, and then you would buy, right? But the real key of where this rule comes into play is first understanding why it works and how the markets actually move. And by understanding that, hey, if we have a range and we have developed what we call a fair value or a fair market, if I am an institutional buyer, I want to be buying at a discount or a good deal. And in this example, anything below 850 is going to be considered a good deal, which is pretty obvious, right? As an institution, I want to be buying low and selling high. But what other information can we actually use this for? Well, this is where we start to identify bear and bull traps and why understanding this rule is so important, right? Because you can see if we look at this example on CLSK, and I'm about to show you another example in just a second here on a futures chart, but if we take a look at this, you can see that we have another range established. We go from this low at about $6 all the way to a high at about $23.38. Right? And you can see we actually do go drop right in that 50% retracement mark, but we don't really get below it. And the reason that's so important is because, again, institutions want to be buying below this 50% retracement mark. So why is this important? Well, if we know that price goes from a low to a high, and again, we're in an uptrend in this example here, but price goes from a low to a high, and then we pull back, and we don't go below that 50% mark, we now know that there are not any institutional players who are buying in this area, right? Because again, they're only going to be buying below this 50% mark. But if they're buying, if you see people buying above this 50% retracement mark, that means it's actually retail, okay? And this is where we get our first bull trap of the day. You can see that price ends up making another new high. And so again, let's say this is our 50% retracement right there. Price goes up, makes a new high, right? This is what we call a bull trap, okay? You have a lot of retail investors who are buying down here, who are even buying all the way up here, and they're going to get trapped. Because again, this is a fake move, okay? This is not institutions driving this market higher. And so when we go ahead and we make that move higher, it's actually just a fake out, okay? And the institutions who bought way down here are going to be selling all the way up here and then driving price lower. And so everyone who bought in this area, what are they going to do? They're going to put their stop loss right below this low. Everyone who bought here is going to do the same thing. Price is going to drop, and then we can establish that this is our bull trap here. Price moves lower, and then we end up going higher after that. You can see we get below the 50% retracement. Institutions load up below here, and now that they have their buys in, they can send price a lot higher. Now, I want to show you a little bit of a more clear example here on ES futures. It's going to be a little bit easier to understand. So this is an hourly chart, right? And just to first off identify this, we want to start with trend overall, okay? And at this point in time, price is starting to see higher highs and higher lows, right? We have high, low, high, low, high, low, high, etc. You get the gist, okay? So we're very obviously in an uptrend. And I want to talk about this move right here from this low to this high. Because what is happening, right? We establish ourselves a range, right? So we have a low just like this. We have a high just like this. And at this point, we have established ourselves a range. And when we have a range, we have an assessment of what is considered fair value. So at this point in time, if we take our retracement tool, go from low to high, the 50% mark is going to be right here, okay? This is what we consider fair value. This is where we should see an equal amount of buyers and sellers in this area, or institutions who want to be buying at this area or below it, right? So what happens when price doesn't go to that 50% retracement mark, which again, I'll just mark out, it's right around here, and then we end up going higher. We see this continuation move, okay? This is very, very important, right? So just drawing out what happened, right? We have a low to a high, pull back a little bit, and then we have a continuation move like this, okay? If this pullback does not retrace more than 50%, then this is a fake move. This is a bull trap. This is a fake continuation move, okay? Because the people that were buying here were not institutions. These were not like legit institutional buying. This is just a fake move higher to get retail to buy all the way up here. So what do we notice happens? Price goes up, we pull back like a tiny bit, right? Maybe like 15, 20% of this entire move. Then we see a continuation move higher. So what happened, right? Anyone who's buying up here is simply getting trapped, okay? Because again, the real buying happens below that 50% mark. And so what happens is you may see this as a solid uptrend, and you may be looking for a pullback to buy, you know, like right here from another leg higher, but this is actually a trap. This is where you don't want to be buying because we never had that retrace. This is actually considered liquidity, right? So you see price moving higher. We're in an uptrend. We're breaking new highs. We're quote unquote breaking structure, right? We're doing all these smart money concept things. And then boom, price ends up dumping, right? Why did we dump? Because we didn't retrace below 50%. We didn't have institutions get in. They're not buying all the way up here. Okay, if you see a strong move higher, a little pullback, and a strong continuation higher after that, institutions are not going to be buying up here. They're going to be buying all the way down here. So it's very clear and it's very obvious to point out, hey, this is not where I want to be buying. I want to be waiting for a retrace. So price then comes all the way back down. Do we break this low? No. Again, understanding stops and market structure, you'd want to have your stop loss under a strong low, which would be here. It's a whole nother topic we can get into. But price comes back way below this 50% retracement mark. Institutions load up here. We have like a news spike right here, right? A lot of more manipulation, a lot of, stop hunts, a million different things happening here. But then eventually, after, institutions shake out more retail even down here, then we get the move higher, okay? And this process continues and repeats all the freaking time. And here's why it's really important, right? Because you're going to see an uptrend form like this, and then you're going to see something like this happen. And because this low right here did not go 50% from the most recent low here, it's actually just a fake move. And so it's very, very common to see something like this happen, right? We have a short pullback, we break that low, and then we end up going higher. And it actually becomes a trap both ways because a lot of times price will break this low here, and then everyone will get bearish, right? They'll see something like this happen a lot of times too. Price goes like this, small pullback, goes like this, and they see like a head and shoulders as price starts to come down, right? You get the shoulder, and the head here, right? And so a lot of times you get caught in both a bull trap of buying up here or buying on a pullback. You're having your stop loss below this low when this low is actually liquidity. And then price comes down and we start to pull back and we start to pull back again. And you start thinking, oh, this is a head and shoulders. This is like a bearish position here. Let me go ahead and get short. And then price ends up ripping higher because now this low did retrace 50% from the high. So now you have institutions who are buying down here after we take out the stops of this liquidity because this move was not more than 50%. Okay. So it's a very, very simple rule that actually has a lot of different involvement when it comes to trading these markets and understanding how they actually move. Now, another example I want to show you guys this, which is really, really key, is actually going to be on the S&P 500 in general in like a weekly or yearly time frame. And here's what's actually crazy. If I go to a weekly time frame, you can see back after 2020, there's a huge run up, massive, massive run up, right? And so for the institutions that bought all the way down here, they're obviously going to be selling all the way up here. And where are they going to look to re-enter for a move higher? Are they going to be buying all the way up here? No, right? Obviously, we have not had a 50% retrace in a while. Price just keeps going higher and higher. And eventually, we start to see some selling. Okay, eventually, in this case, we start to see some selling at the end of the year. Price ends up dropping down a little bit. Here's what's actually really crazy. If we take a retracement tool from this low of the 2020 all the way up to the high, look at where we go. We go right to the 50% mark, like on the dot, and then we end up rallying higher. And the same thing is going to go as we continue into the future as well, right? We go from this low all the way up to this high. Now, in a time frame perspective, have we retraced more than 50%? No. So what does that mean? It means at some point, if I'm an institution and a long-term multi-year player, I want to be buying below this 50% mark. Now, can price continue to just keep rallying and make these mini uptrends for a while? Yes. Does that mean I want to be buying all the way up here? No, okay? And typically, you see these huge retracements happen every once in a while, right? It may not be for 10, 20 years, but eventually, we tend to get them after every so often, right? You can see we get this pullback here from this low all the way up towards this high. Where do we go? Right to the 50% retrace mark. And we end up going higher, and then same exact thing. And so you can see that this happens over and over again because, again, same thing, like the price of coconuts, like the price of water bottles, whatever you want to think of, right? The markets act like an actual product. And if 50% is going to be considered fair value, I want to be getting a good deal. I don't want to be getting in at fair value. I don't want to be getting in above fair value. I want to be getting in at a good deal. And this is where a lot of people get it wrong, is they're not getting in at a discounted price or a good deal. They're simply waiting and buying way too high. And so I see the time and time again, you'll see a range where we have a deep retracement, we have a small retracement to move higher, and this is just a bear trap. This is just a false continuation move. This is actually liquidity where price can go ahead, go lower, then back higher, right? And so what happens is we go lower, we hit our 50% retrace mark, just like this, okay? Institutions are going to be buying all the way here in this move, just like that. So I'll go ahead and make this green. They go ahead and they buy here, then they send price higher. And so you have both the bull trap of your retail who's buying all the way up here, right? And then you see a huge move lower, and on a pullback, you have, again, retail trying to short here, right? Because they see a head and shoulders. So they're trying to short here for a move lower, just like this. So they're trying to short for a move lower, just like this. And then they end up getting squeezed out, and that fuels the move even higher again. It's a repeating cycle. It happens time and time again. And if you can understand this rule, simply like looking at the ES futures chart, you would have known to not be buying up here, waited for the pullback, then wait for a move and a shakeout to then have price continue higher. And so by implementing this rule, and again, no matter what your strategy is, you're going to take less losses, take more wins, and also avoid getting stopped out at the wrong spots. Because if you ever feel like you keep getting stopped out at the lows, you're getting stopped out at the highs, or you're getting stopped out down here, it's simply just not looking at the market the right way, and keeping the 50% rule in your trading is going to get you out of this entire situation. Now, what's really important is that you have to use this rule in conjunction with market structure. If you don't have a good understanding of market structure, it's going to be very, very tough for you to actually use this rule and implement it in your trading. So what I want to do for you guys that stuck until the end of this video is give you access to a free market structure course. Okay. And what I've done is I've put it inside the Vault, which is my free community. Right now we have about, a little over 4,000 members inside it. I'm going to leave a link to the description below. But once you're inside this community, again, 100% free, head over to this Classroom tab right here. Go scroll down a little bit, click on Market Structure Mastery, and there you go. I have 5 specific videos going over exactly how to spot a fake trend, how to identify the real trend, how to use time frame analysis. Everything you need to know about market structure is going to be inside the Vault, inside of this course. Okay, and again, I'll leave the link to the description, so you can go ahead and join this for free. We have a bunch of other cool things in here as well. Really nice community, incredible different courses, stock scanning, risk management tools. Everything you need is going to be in here. But highly, highly recommend you go ahead and join that now so you have a good understanding of market structure, so you can actually use the 50% rule in your trading and start making a lot more money. But with that being said, guys, hope you did enjoy the video. If you did, make sure to subscribe, check out and join the community in the link below, and I'll see you guys in the next video.